This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, we're still looking at Chapter 8 of the free lecture notes, the relevant cash flows, how we arrive at the net cash flows each year in order to be able to discount. And in previous lectures, we've dealt with working capital, we've dealt with tax. The final one is inflation. And the reason inflation is relevant is that you see, in real life, when we're estimating what the cash flows will be in future years, well, a problem we've got is, of course, we have to estimate what rate of inflation there'll be, because although, our revenue may be 1,000 a year at the moment, but if we think there's going to be inflation at 10% a year, then the actual cash we'll get, the revenue will inflate, will get higher, the cash will get higher. And very, very often in the exam, they tell you what they expect the revenue would be without inflation. They tell you what we expect the inflation rate to be. And we need to work out what the expected cash flows are, and then we can carry on and discount in the normal way. Now, to show you what I mean, have a look at example 5. Let's have a quick read and then we'll do it. Ventspils plc are considering buying a new machine in order to produce a new product. The machine will cost 2.8 million. It'll last 3 years. An estimated scrap value of 1 million. No problem. We expect to produce 10,000 units per year of the new product, which will be sold for $20 per unit in the first year. Production costs per unit at current prices are as follows. Materials $8, labour $7. There's going to be inflation. We expect materials to inflate at 8% a year and labour at 5% a year. Fixed overheads of the company amount to $1 million. We've decided 20% of these should be absorbed into the new product. We expect to be able to increase the selling price of the product by 7% a year. An additional 200,000 of working capital will be required. And we've got tax. Capital allowance is 25%, tax at 25% a year in arrears, the cost of capital 10%. And so here we've now got really what could be a full section C question. Now we've got mention of working capital, mention of tax, and we've got inflation. And we're asked to calculate the NPV and decide whether to accept or reject. All right, let's go through. Always, first thing you should look for is how many years are there. And where is it? Oh, second line tells us it's expected to last for 3 years. So set up your columns 0, 0, 1, 2, 3. And as I said in the last lecture, when there's tax involved, always leave space because you're quite likely to need an extra year. Let's go through first of all, the operating cash flows. And here we're going to have to work them out because we told about the selling price, we told about costs, materials, labour, whatever. So one by one, first of all, the sales revenue. And what does it tell us? It tells us in the 4th line, we expect to produce 100,000 units a year, and they'll be sold for $20 a unit in the first year. So, no problem. In the first year, 100,000 units, $20 a unit is what? 2 million. And there's the cash we expect to receive if we're selling them for $20 we're going to receive 2 million at the end of the first year at time 1. So at time 1, there's a cash inflow of 2 million. In the exam, never have so many zeros. It gets absolutely ridiculous. You'll be expected to generally work to the nearest 1,000. And so 100,000 at 20 is 2,000. So all the way through, I'm going to work in thousands. So although it's actually 2 million, as I say, do it to the nearest 1,000. What about the second year, though? Because it's still going to be 100,000 units, but it does say towards the end of the question that we expect to be able to increase the selling price by 7% a year. And so, we're still selling the same number of units, but surely if we put the price up by 7%, the revenue will go up by 7%. And so, in the second year, it'll be 2,000 plus 7% of 2,000, or 2,000 times 1.07. If we multiply by 1.07, surely that's 2,000 plus 0.07, or 7% of 2,000. So the revenue we expect, the cash we expect in the second year, 2,000 times 1.07 is 2,140. And we expect it to go up by 7% per year. So surely in the third year, we need to increase by another 7%, or multiply by 1.07 again. 2,140 times 1.07. Sorry, what I calculated? 2,140 times 1.07 is, I say, work to the nearest 1,000. And on that basis, I get 2,290. So we're inflating at 7% per year. And do notice, incidentally, it doesn't matter here, but could be relevant in other cases, the 2,290, it was 2,000. There's been 2 years inflation at 7% per year, multiplied by 1.07 twice. And of course, exactly the same figure. Should be, sorry, 2,000 times 1.07 twice. 2,290. All right, anyway, there's the revenue. Let's now look at the costs. And the first cost mentioned is materials. But here, be very, very careful and look for this word, because it's different than what we did with sales. With the sales, we were told the selling price in the first year would be 20, and therefore the first year's cash was 20 a unit, or 2,000. Materials, though, we told it's $8 a unit at current prices. Now think about that. Remember, we haven't yet bought the machine. We're considering whether to buy it. And when you're doing your costings, what you're likely to do is, let's ring round suppliers and see how much they're charging for material. $8 a unit. But that's the price at the moment. That's, if you like, this year's price. But we're not going to be actually buying the material until next year when we've bought the machine. And so the price we'll pay in the first year won't be $8 at all. It'll be $8 plus inflation. And so what will it be? If I work in thousands again, it's 100,000 units. At current prices, it'd be $8. But by the time we actually buy it, which is next year, time 1, it will have gone up, but what's it say? Materials are expected to inflate at 8%. And so we will multiply by 1.08 to inflate to get the actual cash flow, which gives me a cash flow 800 times 1.08 at time 1 of 864. It's an outflow. And so do see the difference here. Read very, very carefully. If you're told what the cash will be in the first year, as we were with the sales price, we use it. That was the cash flow. If ever you're told a flow is at current prices, then automatically in 1 year's time it'll be higher by the rate of inflation, in 2 years' time higher by 2 years of inflation, and so on. Let's carry on here though. It's going to carry on inflating at 8% per year. It's still 100,000 units each year, so second year multiply by 1.08, and third year you'll multiply by another 1.08, which gives me what? At time 2, 864 times 1.08 is 933. The third, time 3, another 1.08 gives me 1008. What about labour? Well, again, labour, it's $7 a unit, but it's at current prices. The first payment is in 1 year's time. If it's at current prices, there'll be 1 year's inflation. I'm running out of space here. So 100,000 units, $7 at current prices. But what's the inflation rate? For labour, it's 5%. And therefore, the actual cash outflow at time 1, 700 times 1.05 is 735. And then, of course, carry on inflating at 5% rather each year. So at time 2, 735 times 1.05, 772. And at time 3, another 1.05, 810. I hope you're checking my figures and I hope they're right, but I'm more concerned about the principle. All right, any other operating flows? Oh, fixed overheads. But read carefully. Fixed overheads for the company currently amount to £1 million. The management accountants decided 20% of these should be absorbed into the new product. Well, I mentioned this in the first lecture on this chapter. Absorbing means charging. You can split or charge the overheads between different products any way you want for profit purposes. For discounted cash flow, we're only interested if the total fixed overheads are going to change. And there's no mention here of the total of £1 million changing. We're just charging it differently. And so the fixed overheads are not relevant. They're only relevant if you're told that there'll be extra fixed overheads as a result of doing this project. So there are no other operating flows. The net operating flow, time 1, 2000 minus 864 minus 735. 401, time 2, 2140 minus 933 minus 772. 435. 2290 minus 1008, 810, 472. What do we do next? Well, I think all the rest of it we already know how to deal with. We work out the tax on the operating flows. At what rate is it? Here it's 25%. And it's 1 year in arrears. So on 401 at 25%, the tax is 100, an outflow 1 year later at time 2. 435, 25%, is 109, 1 year later at time 3. And 472 at 25%, 118, 1 year later at time 4. We then bring in the capital flows. So the original cost is what? Second line, 2.8 million, but remember I'm working in thousands. And the scrap proceeds. It says after 3 years, it has an estimated scrap value of £1 million. And so, presumably, we've taken any inflation into account already in estimating what we'll scrap it for. What do we need then? Well, the tax saving on the capital allowances. I don't know, it might be an idea to have a go at to pause the lecture and have a go at this yourself, because we've been through how to deal with it, you know, and then put the lecture back on and check you got the same. However, I'll leave space, I'll do workings for the capital allowances. The initial cost, 2.8 million. And so the first capital allowances, 25% reducing balance as 700, going down to 2,100. So the tax saving, the tax rate is 25%. So a tax saving of 175. I'll put it on the cash flow table in a minute. Let's finish off the allowances. Second year, 25% of 2,100. 525, which brings us down to 1575. The tax saving again, 25% of 525. 131. Now remember, we carry on like that every year until the last year. This one again lasts 3 years, and so the third year is the final year. And in the final year, we simply deduct the sale proceeds, which are what? 1,000. And whatever's left is a balancing allowance or a balancing charge. Well, this time the sale proceeds are less than the tax value, so there's a balancing allowance. There's an extra allowance of the remaining 575, and so a tax saving on it at 25%. 144. So nothing new there. I say we've been through the calculating the allowances in the previous lecture. Let's stick them on the table. They're all tax savings. 175, 131, 144. 175, 13, 144. And always tie them in with the same timing as the tax on the operating flows. So you don't need to think anymore, but since the operating flow, the tax on it was 1 year in arrears, so the first tax payment at time 2, equally your first allowance saving at time 2. Finally, is there any working capital? Yes, there is. 200,000 is required at the start of the project, so an outflow at time 0 of 200. No mention of any more needed. Well, we get the 200 back at the end of the project, time 3. So, what are the net cash flows? Inflow 401, inflow 510 at time 3. $1,694 and finally at time 4. 26. Again, I think I've got my arithmetic right, but if I made a mistake, I'm sorry, but you can check with the answer in the lecture notes. Finally, though, let's discount. What's the discount rate? Cost of capital is 10%. And so from the tables, 1 year, 0.909, 2 years, 0.826, 3 years, 0.751, and finally 4 years, 0.683. So the present values, sorry, it won't take a minute. And finally, the net present value, 365,421, 1272, 18, minus 3,000. The NPV, I get to be minus 924. And so, of course, after all of that, we've ended up with a negative net present value, and therefore we would reject the project. Now, a couple of things before I leave this. First of all, in section C, where you could easily get a question just like this, that would only be part A, you know, that, I don't know, maybe 10 marks, so it's a rush doing all of that. But obviously, it's taken me longer because I've been talking through it. But the section B will be writing. I mean, as we go through all the chapters, we'll cover all the areas you can be asked to write about. But if you were asked for this one, what reservations would you have about your decision? Well, in the last chapter, I mentioned reservations in general about the estimates and so on. But a huge reservation here, of course, are our estimates of inflation. You know, we've estimated materials go up at 8%, labour at 5%. How do we know? You know, the inflation could be higher, could be lower. We've estimated that we'll be able to increase the selling price by 7%. Will we? You know, we've got lots of reservations, but the rates of inflation, of course, always are. Secondly, a bit of terminology, because of one other thing you just could be asked to do relating to inflation. Do appreciate here that what we've done is we've discounted, as usual in fact, the actual cash flows at the actual cost of capital. And the terminology, another word for actual cash flows is nominal cash flows. Another word for the actual cost of capital is the nominal cost of capital. And then because I'm going to show you in the final lecture, an alternative that just could be asked, most questions when there's inflation, this is what we do. We discount the nominal cash flows at the nominal cost of capital. And you could quite likely use the words, if he uses the words nominal, it means the actual cash flows, the actual cost of capital. And incidentally, the cost of capital in the exam given is always the actual cost of capital unless told differently. Now you may be wondering why I've mentioned that, but you'll have to wait till the next lecture where I'll explain what the alternative approach is, which wouldn't, you'll see in the next lecture, it would not be relevant in this question. It would not be possible to use an alternative approach. You'd be told, you'd be expected to do what we've done, and in most questions, get the actual cash flows by inflating, as we did. And having got the actual cash flows, then as normal, discount the actual cost of capital. However, because there are situations when another approach might be needed, we're going to have one more lecture on this chapter, again looking at inflation.